I've got a presentation I've pulled together, which really is just going to focus on a couple key points just to illustrate where we are in this cycle for mining investments. So where are we in the mining cycle? What contributes to the cycle? And what conclusions I take from my highlights. So I'll start off this morning just to draw your attention to major drilling. We use major drilling, which is one of Canada's largest drilling service companies in the mining industry, as a good proxy for where we are in the cycle for mining activity. And what we have charted here for you is really just the gross revenues of major drilling annually. And what we can see here is that since really 2017, the activity as shown by gross revenues for major drilling has ticked up. We know in the mining industry, drill rigs are the truth machine, that every dollar of exploration that is raised in public markets ultimately will find some its way into a drill rig to really test for new mineralization or explore for new commodities. As this chart would indicate to us, that activity seriously turned in 2016, but it wasn't until 2017 that we started that change. Major drilling, though, is a major mining company, and over the years they've really graduated from 100 drill rigs to 600 drill rigs. And this chart is a little bit of a massage that I've done to take out of the revenues what I call growth by acquisition. So we're just looking at the organic growth of major drilling revenues here, sanitized for its M&A activity. It shows the same thing. Basically, 2017, the drilling activity of major drilling did show a nice uptick. Even when we look at it in a little bit more detail, now I'm looking at the quarterly progression of revenues for major drilling. And, it was our hope that Denis Larocque, who's President and CEO, would actually present this firsthand. But unfortunately, they're coming up to their year end and they are in blackout. But nevertheless, what I've included here is just the gross revenues of major drilling plotted quarterly. And the bar at the end is what we expect their year end fourth quarter numbers will look like. But what we can see, even in spite of a bit of a slowdown as a result of the pandemic over the last 12 months, the activity as measured by growth in revenue shows clearly that mining is back, and solidly so, and is still expanding. So mining activity is full on. We know that. And what else we know is if we look at the stock price of major drilling, it has shown a very good rebound, since really the start of the pandemic. This chart is really quite demonstrative in the sense that it's gone from under $3 to over 10 in that period of time, all in spite of a bit of a turn back in activity due to COVID restrictions. But it's clear, mining is back. We're seeing it in the revenue growth of major drilling, which is broad-based, covering a lot of commodities, and the equity market is also recognizing that this activity has come back and is rewarding major drilling for their good performance. So one of the other things that we would take, and major drilling is covered by my colleague Ryan Hanley, and we do sit in on the quarterly conference calls. But what some of the other evidence that we've seen that's not reflected so much in the revenue projection, but major drilling are telling us, look, experienced drill crews are in short supply. It's hard to find good, competent drillers. That just shows, again, another indication of growth in the drilling space. Activity, looking for various commodities, has moved beyond gold, which is good. It's much broader based than just gold. Initially, it was a gold based recovery, but it's moved beyond that. Also, exploration activity has gone international again. Initially it was really domestically driven, but that has moved beyond our domestic shores and in fact has gone international. And to that end, major drilling, one of their recent announcements is they went out and bought another drilling company in Australia. And so they've moved back to Australia. Again, another evidence that that international activity has picked up across the board. And the other thing, which I didn't really plot up for you, but it's fair to say with the growth in revenues, so has the gross margin of major drilling. It's improved, and that means that the drillers are able to ask a better price because there is more of a shortage and more demand for their services. That's all very constructive, shows that mining is back, and that the activity is actually at quite a robust level. And that's really the conclusions that we take from the major drilling as a proxy for the industry. The other thing that, as I've already pointed out, we've had some pandemic considerations slow down, but there's no sign that we're overextended in the sense that we're not back to the silly seasons that we saw back 2007 where, you couldn't get a driller and prices were, in the stratosphere. When you asked for a drill price, it was pretty high. So one of the other things we'll take a look at about when we look at where we are in the cycle. So major drilling has nicely shown us we're back. What are the other contributing features that drives the cycle? Clearly, higher or lower commodity prices, and that's impacted by economic activity, interest rates, supply side considerations, whether we have a growth in supply or not. Also, another part of the catalyst in the cycle is the willingness of investors to actually get involved. And that can be, are there competing sectors for investment dollars? Are there been new discoveries that's attracted attention? And also one of the other things which I'm not presenting today, but I do talk to from time to time, the evolution of ETFs and the move of money from active managers to passive managers has not been very good for mining overall. But today I'm just going to focus on a couple of key points. And clearly one of the key points here is the commodity prices themselves. And what we're looking at here, selected metals, looking at price performance year to date over a 1 year, 2 year, and 5 year periods. But what you could really see here is pretty well right across the board. We have had good commodity prices. And that really is the ultimate catalyst that drives this mining activity, to go out and look for more mineralization and generate cash flow. Initially, it was really quite a gold-driven, I would say, recovery. But as you can see from the chart, it's moved well beyond that to some of the platinum palladium group that have shown great performance. But more recently, it's really been the base metal suite of metals that have shown some very good performance. Iron ore, as an example, has had spectacular performance. Nickel, copper also have caught up. And some of what I'd call the new technology metals are also there. Things like lithium and cobalt. These are the newer technologies. They clearly are there and doing very, very well. And I've thrown in here uranium as another consideration. It has shown some life as well. And what does this mean? Well, if we look at the top 5 funds, flow-through funds in Canada, yeah, they're raising more money. And this is only for the 6-month period, 2021, but we're already ahead of where we were previously. So clearly, investors are back. So everything is very constructive. If we look at it, we are in a bull market. This is the JDX and the JDXJ. We're up 150, 180%. So we are in a bull market. There's no doubt about it. And why are these conferences important? It's good to get to know some companies. And 2 of the presenters we have today, Wesdome, over the last 3 years, up 500%. That's a spectacular performance, driven by more than just the commodity. It's also driven by some very good success. Champion Iron, covered by my colleague, Jock Wortman, as well. With these iron ore prices, it's had absolutely great performance as well. So it's clear. We are in a bull market, and we're not at an extended part of a bull market in mining equities, and hence why this conference is so important. So let's get on with the conference. And behind me, I'm going to introduce David Grothwell. David, well known. I've known David way too many years. David has had great accolades. He's been voted CFO of the year. IR Magazine voted him the top CFO, CEO for IR Relations for a couple years back to back. He's very, very well known in the market. I got to know him originally when he was Agnico Eagle CFO, but then he went on and took a very important mandate as president and CEO of Hudbay, which is one of our large zinc producers. And then he took on the mantle of president and CEO of Goldcorp at a difficult time in their life. He now is running his own Marshall Precious Metals Fund. He's chairman and CEO of that. And as well, he's president and CEO of a gold royalty company. So with that, I'll pass the mantle on to David Grothwell. And over to you, David, for your wise commentary.
Thanks, Barry, and good morning, everybody. And Barry, your presentation was actually thematically exactly in line with what I'm going to be talking about today. I think it's the emergence of mine development and exploration, which has become an existential imperative for the industry. But I have come from an operational background. I am running a precious metal investment fund with some Chinese partner investing in early stage exploration. And we made a macro call there about a year ago that we'd start to see capital allocated back into the exploration game. And really before that, the juniors couldn't raise capital to save their lives. And we went through a nuclear winter in terms of exploration, but we're starting to see obviously a resurgence in that, in activity on the drilling side. And we're seeing that juniors can start to raise capital again. And the other thing that I'm doing, actually it's my full-time job, is chairman and CEO of Gold Royalty Corp. We just IPO'd it on the New York Stock Exchange a couple of months ago and raised about $90 million US. And the reason I position myself at that end of the spectrum, both in terms of running Marshall Precious Metals and Gold Royalty Corp, is royalty companies and streaming companies are an extremely important part of the ecosystem as the industry refines its skills in mine development and exploration. The royalty companies provide a meaningful source of capital for those early stage opportunities, so we can conduct that meaningful exploration and development to replace depleting reserves, both on the base and precious side. And so, we're going to be very, very focused over the coming months and years to putting that money to work with these early stage developers, explorers, taking royalties back, and really providing leverage to both the commodity and exploration success through the royalty structures. And again, that's an extremely important part of reigniting development and exploration in the mining business over the next several years. But I do come from an operational background. Gold Royalty Corp actually is unique in that we have a collection of people on the board management that all have come from the operating side. Ian Telfer is the chair of my advisory board, and Ian was the grandfather of and the pioneer of the streaming and royalty model when he created Wheaton Precious Metal at a Gold Corp about 15 years ago. I also have Allan, who's my successor at Hudbay and my chief operating officer when I was there, 35 years as a mine builder and operator. And there's a collection of other people within that board that come from a very similar background, and collectively is about 250 years of operating and mine development experience within that group. And I'd say a lot of them have a very similar background to mine. Obviously I've been involved on the M&A side in the mining business. The largest by far was the merger with Newmont, which was a $10 billion acquisition for Newmont, but a merger, when you look at the combined market caps at the time, of about $32 billion. And Newmont's essentially tripled in size. And that was done in response to Barrick and Randgold coming together. It became an existential issue for Newmont, and we got together and created the world's biggest company in the gold space by market cap and production. But while I did that deal when I was at Gold Corp, if you look at the collection of deals I've done before that in my career, they've all been relatively small. They've all been tuck-in type acquisitions. There's the three that I did at Gold Corp, Hudbay, but before that at Agnico Eagle, we built 6 mines in the 12 years that I was CFO there, and all 6 of those mines were acquired through tuck-in acquisitions of juniors. Juniors are an extremely important part of the ecosystem for the operators. We need the juniors to be successful in their exploration efforts because they populate our pipelines at the end of the day. And the reality is operators are terrible at grassroots exploration. If you think about the mindset required for exploration, it's very much a risk-embracing, entrepreneurial type of approach. Whereas when you're running an operating company, it's all about mitigating risk. It's about making sure your workforce is safe, that you're environmentally responsible, that you don't have capital or operating cost efficiency, operating or capital cost inflation. You need to really avoid risk at every quarter when you're running an operating company. And you have to hit your targets, obviously, whereas exploration company is really swinging for the fences almost all the time. And the failure rate is very, very high. I'd say typically 19 out of 20 times the juniors really don't succeed, but we need them. They're such an important part of what we do in the mining business. If we didn't have them populating our pipelines, we wouldn't exist. We wouldn't have anything to develop. We wouldn't certainly be operating mines. Virtually every meaningful discovery on the exploration side has come through the juniors. And as a result, in my career, whether it was at Gold Royalty, Gold Corp, Hudbay, Agnico, we always ran a small incubator fund investing in juniors because we recognized that juniors didn't always have access to traditional capital markets. And they required our capital to continue what they do on the exploration side. So effectively what we did is we outsourced our grassroots exploration. And that's what the industry does, whether they mean to or not. They really leave the discovery game to the juniors who have that entrepreneurial and risk-embracing mindset required to make meaningful discoveries that eventually we can develop and apply our balance sheet operating experience on the operations side in terms of the established producers and operators. And again, I came from a mine development side. I've been involved in the construction of about 14 development stage assets over my career. Some of them you'll recognize. Some of them are quite small. A couple of them don't exist anymore because the reserves have been exhausted. But again, virtually everything that you see here came through a discovery from a junior. Even Laurent, when Laurent was discovered by Agnico Eagle back in the 1980s, it was a very, very small producer, really more of an exploration stage company, became the behemoth it did today through its partnerships with juniors over time. And again, by applying its balance sheet, mine building expertise and operational expertise, was able to build LaRonde out and a collection of other assets that you see on this map. But through my career with Inmet, where I started back in 1990, Agnico, Hudbay, Gold Corp, we ended up developing about 14 assets or mines over the course of my career. Again, through partnerships with juniors, all of which we tucked in and applied our balance sheet and mine building expertise to bring these operations into productive capacity. So again, juniors are a very, very important part of what we do in the business. And I think that's why I've positioned myself at this end of the spectrum, because mine building has become a lost art, if you will, and we need to get busy. You can see that the exploration budgets only starting to reinflate, but we're still far from peak levels in terms of what we need as an industry to replace depleting reserves. And while we've seen a resurgence in investment activity on the junior side over the last year or so, I'd still argue that it's still quite selective. It's not a wholesale embrace. We certainly haven't seen the generalists come into the sector in a meaningful way. And so we haven't seen that wall of capital that's required to replace depleting reserves. But I do think that's going to happen over the next year or two. We're going to have to see a meaningful investment in exploration and development in order to reverse this downward trajectory that we're seeing in reserves. And on the gold side, we've seen reserves decline about 40% over the last 6 or 7 years. And I should point out, this is simply through depletion. Virtually none of this is because we use lower gold prices or lower assumed gold prices in our reserve calculations. This is because the industry has been largely harvesting its existing operations over the last 6 or 7 years. And if you throw your mind back to 10 years ago, there's a very interesting reason for that. We came out of the credit crisis back about 10 years ago, and we saw a significant surge in gold prices, the previous cyclical high of about $1,900 an ounce. We saw base metal demand as very robust because we were in the midst of the Chinese super cycle. So we saw a coordinated rally in both the base and precious side. And as a result of that, there was a massive investment in new mine development at that time. And a lot of debt was strapped on by the established producers. And what we saw was massive cost inflation in both operating and capital costs, which ate away at the leverage proposition that investors were looking for when they were buying gold and base metal stocks. And so we saw actually precious metals and base metals rally quite strongly, but the equities did terribly because profitability actually diminished in the face of, at the time, all-time highs in both gold and copper and zinc for that matter. And so the investors, rightfully told us, focus on harvesting your existing business. You've over-leveraged. You have to start to generate free cash flow, pay back dividends. And that's what the industry did extremely effectively over the last 6 or 7 years, in that not only did they generate significant free cash flow and stabilize costs and saw their margins grow, return capital in the form of dividends and share buybacks, but the industry massively deleveraged. In fact, the gold industry, and I'd argue for the most part, the base metal sector is at net zero debt today. And in my 30-year career in the business, I've never seen that. So the balance sheets are extremely well positioned. But what we haven't done is reinvest back in exploration and development. So to stabilize costs, we stopped reinvesting back in exploration to replace depleting reserves. And that's why we find ourselves where we are today, where the average mine life of a gold deposit was 20 years 7 years ago, is now 10 years today. And that may still sound like a long reserve tail, but it's not, because typically from discovery to first production, it's a minimum of 10, 15, 20 years. So what that tells you is this downward trajectory that we're seeing in reserves is not going to be reversed anytime soon. And we have achieved peak gold production. So we're going to see a steady decline in gold production for the foreseeable future. That's hugely constructive for the gold price, at least sentiment-wise. Demand is being driven by things like low interest rates, quantitative easing, expansion of money supply, et cetera. We're going to see gold rally for the foreseeable future. And I'd argue that there's no reason we wouldn't achieve the previous cyclical high of $3,000 an ounce, which was 1981's gold price in today's dollars. $850 an ounce in 1981 was about $3,000 an ounce. But we have a remarkable inelasticity of supply to price because the lead time to production is so long. So even if a major discovery were made tomorrow to reverse this downward trajectory in reserves, we're not going to see the evidence of that in production for the foreseeable future. And the industry really isn't making any meaningful investment in new production capacity, in new mines. We've lost those skills over the last 6 or 7 years. We're going to have to refine them. And I would argue it's a similar trajectory on the base metal side. We've seen reserves, at least the quality of the reserves, decline, and we're going to have to see a meaningful investment back into exploration in order to reverse that downward trajectory. It's become an existential imperative for the industry to focus on that and reverse that downward trajectory. And the other thing that will drive is cost structures. As the industry finds itself in investing back, we've seen very stable costs over the last several years. You can see the cash costs for gold and copper have been remarkably stable, and that's been driven by things like weak local currencies, low energy prices. But we're in the midst of what I would argue is a hyperinflationary cycle in the general economy. With all the monetary easing that we've seen, we are starting to see the evidence of inflation. The headline inflation in the US most recently was over 4%, but I think all of us know that real inflation is considerably higher than that. I'm assuming that some of you have tried to buy a house recently. It isn't 4% inflation. It's far above that. And we're seeing evidence of significant inflation across the space. So what I think that means for the industry is, because we're going to have to redevote capital and investment back into mine development and exploration, and we're going to see constraints on things like drilling and on machinery and equipment and people. We're still dealing with a demographic challenge in the mining industry. We're just not graduating enough engineers and geologists and metallurgists to replace the ones that are retiring. We're going to see massive cost inflation driven by hyperinflation in the economy. But I also think because the industry is going to have to devote a wall of capital back into mine development and exploration to replace depleting reserves and production, we're going to see massive cost inflation. What that tells you is the industry really hasn't learned anything. We overcompensated by harvesting our existing assets and not meaningfully deploying capital into new mine development and exploration. And now we're going to have to overcompensate. We're going to see the pendulum swing wildly to the other end, and we're going to see massive cost inflation. It's inevitable because mine lives have become so short that we're going to have to massively invest capital into the sector. So that's great for the juniors. You're going to see a lot of generalist interest back in exploration, I think, in the foreseeable future. And you're going to see the established producers start to re-leverage their balance sheets to an extent and start to invest back to replace their depleting reserves and production. And as I said, on the copper side, there's been a meaningful decline both in reserves from productive assets. There's a lot of fluff in this reserve profile. You can see it's relatively flat, but there's a lot of undeveloped reserves in these profiles that you see here. I think what you really need to pay attention is the reserve grade, which has gone down almost 50% over the last 10 or 15 years. What it's telling you is that the quality of reserves have come down. The near surface high grade deposits on the copper side have been found. You're having to go to larger tonnage, low grade deposits, which means more capital intensity because you need bigger equipment, you need bigger infrastructure, bigger mills. And so that really highlights the challenge of replacing depleting reserves from existing productive assets, because generally the lead time for the large capital intense type copper projects is quite a bit longer than it is for the smaller deposits that were developed back in the past. We're not going to see a meaningful increase in copper production anytime soon. And that's a challenge for the general economy because there's a drive to decarbonize our industries. And copper is a meaningful part of helping that decarbonization effort, whether it's in electrical vehicles, whether it's in improving electricity grids. Copper is an extremely and fundamental element of that. And the industry is ill-equipped to meet the demand requirements, which is bullish for copper prices, obviously bullish for gold because of the supply constraints there and the macroeconomic dynamics and monetary easing. But really, the industry just does not have elasticity of supply to price. We're not going to see a meaningful supply response for quite a bit of time, which means we're going to have to reinvest back in exploration and development in a very meaningful way for the foreseeable future on both the base and precious side. So we are going to see cost inflation, and that's a challenge. I don't know the answer to that, but we've overdone it in both extremes in the cycles, and as a result, we're going to see that cost inflation creeping back into the industry.
David, my apologies. Mark here. We have 1 minute left. We're just about to move over to our next session.
Yeah, then I'm going to wrap up here and just say that if you're not finding it, you're going to have to buy it. And you're going to see a resurgence in M&A in a very, very meaningful way. And I think it'll be a larger volume of transactions. I think in the gold space, we're largely done at the senior level. The big guys have merged, but we're going to see a large volume of mid-tier companies and emerging producers starting to consolidate, to create critical mass, diversification in their portfolio, and to attract that generalist investor who's looking for liquidity.
Wonderful.
I'd like to thank you for your attention this morning.